Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Monday, the 9th of September. Another week in the markets. The Monday, the 9th of September, Bull versus Bear webinar. Steve Miley here on the call. Welcome, everyone. I'm going to go through our Monday run through here today, where we take a slightly bigger picture look at the shape of the week, looking into what we've got coming up for this week, and actually a little bit beyond this week as well. So we'll take a look at that first of all, run through all the macro fundamental, geopolitical, central bank um, um, factors that are potentially going to shape markets going into this week. We'll have a little look back to what was impacting markets last week, and then we'll take a look at some articles from the major news wires that reinforce all of those factors and echo all of those factors, and then we'll take a look at a few some of the analysis. So yeah, let's kick off first of all with every weekend we publish the macro matters and the weekly recap and outlook. So the macro matters in here and the more in-depth look, and then really the weekly recap and outlook, just the condensed version of the macro matters. I'm going to use the weekly recap and outlook just to drive home what we've seen over the last week in here. So global stocks obviously significantly lower. S&P and Nasdaq experiencing their worst weeks in months. Bond yields falling significantly in here, growing concerns of economic hard landing and potential Federal Reserve missteps were the driver force in here, really, alongside some concerns driven out of NVIDIA as well. So we had the August employment report, obviously on Friday. That kind of reinforced. It wasn't particularly bad, only 142,000 jobs added, but we did get if I go back to the macro matters actually in here, we did get, here it is in here. So we did get a revision. Are the revisions in here? Yeah. So look, so the June and July numbers were revised downward by 86,000 jobs between the two of them. So if you take those 86,000 jobs, which effectively we're 86,000 fewer were added, right? So you could take that off of the actually 142 number in here, and it brings it down to a significantly low number. So there were real concerns about those revisions for June and July, and then also the number for August slightly missing. The unemployment rate did continue to tick lower, came in line with expectations. Another thing that actually I didn't put into the weekly week coming out, but the US 210 yield curve is uninverted. Okay, so that's a little bit of a warning sign about concerns about potential growth going forward, concerns over a hard landing. It shows that the Fed now is sort of playing catch up, or the expectations of the Fed are playing catch up. The uninversion of the yield curve is often seen when the Fed is poised to reduce rates and when economic is just softening, signaling potential caution ahead. So yeah, there are concerns that uninversion of the yield curve pointing to, okay, the Fed are now getting their act together. So the short end is going to lower yields faster than the long end. But that's because the long end, remember, more reacting to the economy, and the short end more reacting to what the central bank is doing. And so concerns there around the state of the economy and this potential hard landing that the market is now somewhat starting to anticipate, or as fears over. And the US employment report, as we've got in here, not helping that at all either. Going back to the concentrate on the weekly, so August employment will cover the US. Oh, here's the US two. I did cover it in here as well. Twos, tens in year uninverting, and then the focus into this week ahead of the next week's. And this week, CPI data that comes up on Wednesday. We'll run through the data shortly in the table. And then the week after, the Wednesday after, we get the Federal Reserve on September the 18th. Now the bets are moving closer to the 0.25% rather than the 0.5%. Looking for the Fed to go and only an initial go small on the initial rate cut. And we'll take a look at that shortly. So US and global stocks obviously were lower. Yields plunging significantly lower too. The dollar index went lower back to its recent multi-year lows. Gold futures went higher, back lower, but up close still to the record highs. Remember, gold moves in an inversion often to the US dollar. and also is as a protection against risk. So obviously with risk concerns, people buy gold, the investor will buy gold. So hence gold sitting right up there near the record highs, and oil futures, because of concerns about a recession, moving to a multi-year low, although they have bounced in here this morning. Going into this week, the main central bank activities this week is going to be the European Central Bank monetary policy statement on Thursday. So we'll be keeping an eye on that. Are the ECB, we'll talk about that closer to the closer to. But are the ECB going to follow up with another rate cut in here potentially or not? We'll look at that closer to the time. The main release, as I've already said in here, is the US CPI data going into this week. Other US data relatively light in here. But we'll run through all that in a second. But we do get UK employment, Chinese trade reports, and we also get German and Chinese CPI data also this week. Don't forget, we get the US presidential election debate as well on Tuesday. 9 o'clock Eastern time, live on ABC. That's going to be interesting. That could have an impact onto the markets depending on how well Harris versus Trump occurs and whether the markets see that as market friendly or not. So I'm certainly keeping a bit of an eye on that. So just to run through what we have, we've already had Japanese GDP, Chinese CPI, PPI this morning. We'll have a quick look at that in a second. EU investor confidence also, but nothing of note out of the US today. We'll come to the calendar shortly, though. Chinese trade data coming up tomorrow, overnight, tonight. German CPI, UK employment report, and then we get that US presidential debate late on Tuesday. Wednesday, UK GDP and UK industrial production. Then the big number for the week, the US PPI data. Thursday, we get the ECB are in play, and we also get US PPI. US PPI doesn't usually do too much after we've had this CPI data, which is seen as more important. And then we finish off the week with French CPI, EU industrial production, and then the US Michigan Consumer Sentiment Index. So it's a relatively light on numbers of pieces of data from the US, but we do get that all-important US CPI. Is inflation continuing to slow in here? So we'll be keeping an eye on that going into this week. Looking at the calendar, say today, you see nothing of real note in here out of the US going into today. It's very light. And remember too, it's the Fed on blackout period now as of Saturday just gone, with the meeting now in a week and a half. Fed goes into its blackout period, so there'll be no Fed speakers talking about monetary policy going into this week or beginning of next. So there's 5 things to start your day. Nothing much more in here than we've spoken about. US ex-fears point to a partial recovery, looking for a bounce today, going into the open. Inflation data ahead. That's the CPI data. How quickly the Fed delivers rate reduction will be the crucial. The bond market rallies. So the bond market's been rallying. Remember, higher prices, lower yields. So that will depend on, in the short run anyway, on how fast they cut rates. Bitcoin outflows, ETF funds opposed to their longest run of net outflows. Apple event, I was going to mention that a bit further down the line, but yeah, we'll talk about that quickly now. So Apple joins the crowd leveraging AI to force upgrades. So basically it's the Apple event, and there's an expectation that if you bought your iPhone more than a year ago, you're likely to get access to all of Apple's newest AI features. Okay, so that's significant, right? So trying to drive people to upgrade in here by using the bait of AI. So we have the Apple event that's coming up later today. That's at 10 o'clock Pacific, I think. So what's that? Well, I think 1 o'clock Eastern. I know it's 6 p.m. in here, UK. Yeah, 1 o'clock Eastern. We have the Apple event. And troubles coming in the brew in China as a core inflation cooled to the weakest in more than 3 years. So deflationary pressures in China in here becoming entrenched in here, and that's not a positive either. What else do I have? So there's the Apple event where we've spoken about that. Stocks claw back losses with Fed rate path in play. traders been pricing in front-loaded and faster cuts. Well, are they really? Let's have a look at when we get to the Fed watch. The bond market rally rides on how fast the Fed cut rates. So if it can continue, risk on momentum in stocks that comes to mounting growth rates. So that's what we've seen over the last couple of weeks in here. So that's really looking back. US economic worries are gnawing at investor confidence. China big tech concentration, also risk for markets. And world stocks dip, European shares jump on ECB rate cut hopes. So that's looking a little bit ahead in here. So if we look on the overnights in here, Asian stocks lower, 0.5% down with that deflationary pressures coming out of China, those CPI data in here. Hang Seng down 1.5%. But European stocks up in here this morning between 0.5 and 0.6% across the UK FTSE, German DAX, and the French CAC. And how is that impacting into futures on the overnight in here, where we're up significantly? We have 1% up on the S&P 500 and 1.3% bouncing with those European stocks in here. The US futures significantly up pre-market. If we look at what we're expecting though now, look, 525 to 550 is where we are. So a quarter point now, a 75% chance of a quarter point, only 25% chance being priced in for a 50%. 50%, sorry, a 50 basis point, a 0.5%. But if we look into the end of the year now, what we do see is in here, so the chances are is only 11% chance, only an 11% chance we don't get a full 1%. This is 1% or more. So to the left of this bar here, 39% bar in here, this is showing a whole 100 basis points. 525, 550 is where we are now. 425, 450. So the market is pricing a 90 cents per chance we get 100 basis points or more over the 3 meetings. And if we and you know, the rising chance now is that we get more. So there's now a 50% chance that we get 125 basis points or more. So the market's certainly starting to price in maybe 25, then 50-50. If we go to the November meeting now, you see we're at there's only a 30% chance we're down 50, and now more than so a 70% chance basically we're down more than 50 basis points. So the market's now really starting to price in with the structure of the curve here, 25 and then 50-50 is what the market is starting to price in, or certainly 25 50-25. So they're certainly looking for a rate cut to come in here. Of only 25, but then a more aggressive rate cuts as we go into the end of the year and then beyond as well. So where's the let's see where the market's expecting us to hit 350, 375, 325, 350 by next May. 300 to 325 by July. So that's the bottom in rates. The market is pricing in pretty much June, July, through the summer, even maybe as low though, in here you can see down to 275. So, but the market's certainly pricing in. There's the peak there, 300 to 325. So that's a total of, 225 basis points lower. So a 2.25% rate cuts by July of next year. So kind of quite aggressive. So once they get going, it's like pretty much looking for rate cuts going right the way through in here into next summer. On the bond markets, we did spike down, a slight backup in yields actually at the end of the week, but we did significantly move to lower yields going into the end of the week in here with that expectation of a more aggressive Fed and concerns about the economy, and that's obviously reflected in the bond futures in here, still across the board in here, 30 years, 10 years, 5 years, 2 years, all pointing north, all pointing higher, all staying bullish. Stocks, obviously the sell-off that we saw on Friday looking more negative, although that bounce we've seen here overnight, this was written before obviously I knew the market was bouncing by that amount. So market's looking like they could push to the top side, but we've already sold off significantly in here. It does look negative on a bigger picture going into this week on both the S&P and the NASDAQ, but obviously that significant bounce we've had in there today, potentially going to see some follow through on the cash market open. But take a look at the levels I have in the support and resistance levels in here and work off of those. If we start to claw above, and we already have clawed above some of these resistances in here, then there's potential that we could see follow through to the upside today. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe. Duncan will be with you tomorrow for another bull versus bear webinar. Bye.